Hello again, this is Robert Schein, Managing Director and Partner of Blanke, Schein Wealth Management. Today is Thursday, September 17th of 2020. Thank you for joining us on our daily updates. We're providing daily updates to our clients, friends, and family for the simple fact that there's maybe some stories or some headlines that markets are paying attention to that you might not get on your daily headlines. So it's real-time empirical evidence and stuff that the markets are paying attention to, whether they move up or down or just even neutral. I'm reporting on a daily basis. And so thanks for watching. Stay tuned. Let's talk about what markets are paying attention to in the last day or so. So our first update today is basically talking about the mixed signaling from the Federal Reserve. Federal Reserve Chairman Jerome Powell yesterday, just to set the table, concluded a two-day meeting with a press conference and essentially stated that the Federal Reserve will be fully accommodative to support a full recovery. Now, the Fed's definition, it's very important that we understand this. According to their definition of a full recovery, essentially means unemployment rate dropping below 4% to about 3.5%. And Federal Reserve Chairman Jerome Powell referenced earlier this year when we had a booming economy, we had low unemployment, about 3.5% level. That was the feel-good number where the economy was growing so greatly that, broadly speaking, from different subsectors of the economic spectrum, all the way down to basically it's the have and have-nots of the economy. That's where when the economy in the U.S. is firing on all cylinders, everyone feels that wealth effect. Okay, and it doesn't matter what household or where you're from, jobs are prevalent. Therefore, it really affects everyone in a positive aspect or a positive impact. Speaking so. Federal Reserve says in full recovery, meaning employment. At the same time, they're going to invite in inflation over time. But the markets now are confused by this because there's also this inverse relationship. Right? How do you support interest rates for the next 2-3 years to be low, but yet you have to have inflation creep in over time? Essentially, you're asking for inflation to creep in. That's where we're talking about. If you followed me on my daily updates, it's the real assets you want to own in this window of opportunity when the Federal Reserve does this signaling. Here's what I mean by that. You want to own stocks, U.S. equities. You want to own real estate. You want to own real assets like gold. We'll talk about that in a minute because those are inflation adjusted. Those things will stay up ahead of inflation, especially when the Federal Reserve is trying to invite inflation on the short term and the long term. Now, long term, they will get ahead of the 2% inflation target. They will allow the U.S. economy to run hot and in the years to come, essentially over that target, if you will. And we will watch the GDP and some of the inflation and manufacturing numbers as it relates to that, as we get to that. And obviously employment is going to be that one factor that ultimately is going to be the barometer of whether the Federal Reserve is supportive or starting to pump the brakes on the stimulus. But this is that go time between now and then. You're going to see over the next few years and even months to come, you're going to see this dynamic play out. But when the Federal Reserve gives you this playbook and in professional money management world, we take notice because it's not a little bit, it's very significant as it relates to managing portfolios. That being said, I want to talk to everyone about the inverse relationship that we see play out. There's a lot of dynamics going on. And in the middle, I put the Federal Reserve, and their two key initiatives are full employment, right? A full recovery in the U.S. economy, but also staying ahead of inflation. They said they're going to go for that 2% inflation target and exceed that before they start essentially tinkering with interest rates, if you will. Well, interest rates and bonds have an inverse relationship, meaning if interest rates go up, bond prices go down. But if interest rates go down, bond prices go up, okay? Same thing for gold and the U.S. dollar. In the last 2 weeks, we saw gold go up, okay? It's had a rally of sorts. Overnight trading, the U.S. dollar caught a bid. It went up and gold goes down. Why did the U.S. dollar catch a bid? Well, reduced unemployment numbers. The employment numbers for the United States are getting better. They have a long ways to go. We have 30 million plus unemployed or wants to claim unemployment, including shadow unemployment. You got an 8.4% unemployment rate. There's a lot of work that needs to be done. Again, enter what Federal Reserve Chairman Jerome Powell said yesterday. He can only do so much. In fact, there are so many tools out there, but it comes back to my story yesterday talking about mom and dad savings and loan, right? you need both sectors, or excuse me, both to complement each other. So Federal Reserve using tools of monetary policy to fully support this recovery and ensure that we get out of this. It's called escape velocity. You want to escape out of a potential recession. That's essentially what they're doing by adding liquidity, backstopping everything they need to, and inviting inflation in, and almost asking for risk assets, right? 0% interest rates. We have negative interest rates. So if you take in, here's how you figure this, and this is what Wall Street looks at as their risk-free rate of return. If you look at the money that's in the bank right now, we know that the personal savings rate is 23% year over year. It's the highest spike we've ever seen, right? In historical speaking, in this period of time. That money is earning in the bank basically negative yields. Okay, it's called negative interest rates, and SIPC rate is negative yield on that, because you have the banks paying you nothing on your money minus the inflation rate. So if you take those two together, you're losing money by having money in the banks. This is the game plan by the Federal Reserve, because they know anybody who is shrewd enough to pay attention to what's happening, inflation eventually will erode your money over time, because asset prices will increase, right? Real estate and a few others, in terms of the equity markets on a go-forward basis. As increasing in asset prices, if you don't have that, if they don't tease that money out of the banks that's getting negative rate of return, then that's the game plan, right? So those people that have money in the banks right now, you're losing money because of what the Federal Reserve's actions are essentially going to do, and they're doing it as soon as it's literally talking about you're standing on quicksand right now. We have a lot of clients bringing us bank funds, and we're finding places that are thoughtful for it, both in a short and long term, that's appropriate to their investment philosophy and goals and feelings and everything. So we're getting those calls, and we're seeing that bank money move over is simply because of this playbook right here. But this has been played out. There's an inverse relationship playing out. The unemployment rate, unemployment numbers are getting better. As they get better, we're going to see this tug of war, the US dollar either going down or going up, and gold going down or going up. All the while, long-term effect, we know what the playbook is reading by way of what the Federal Reserve has said. In the meantime, we're going to see the S&P 500, the NASDAQ, they're all touching their 50-day moving averages, because there's so much to process here. There's so much going on. And so all the markets interconnected. And we saw all-time highs just 2 or 3 weeks ago from the markets. So for them to basically hang out, digest the information that's been sort of presented in the last 48 hours news cycle as relates to going forward. And the other side of that is the mom and dad savings and loan reference that I made earlier. Markets are really asking for, by hanging out in the 50-day moving average and being negative over the last couple of trading sessions, it essentially could even go lower the next couple of trading sessions to send a message to Congress. Congress needs to add more strategic additional benefits and additional support in terms of fiscal support, and Congress needs to come together and work together to get it where it's needed, because the U.S. economy, another take-home point of what Jerome Powell said yesterday was the U.S. economy, the real economy, is still suffering. Small businesses, those that are unemployed, and there's a huge chunk of the U.S. economy in terms of businesses that have been impaired, and they're never coming back. Those jobs, those businesses are never returning. So we've got a lot of work to do on a go-forward basis. We, being the Federal Reserve, stay basically pleading with Congress saying, do your job. Okay, Congress needs to do their job and add additional directed stimulus and support where it needs to actually go in this U.S. economy, because I would tell you, on a go-forward basis, there's a lot of dynamics at play, but the Federal Reserve and monetary policy can only do so much. That's what the market's digesting, as well as selling off in the last couple of days, sending a message to Congress. And what's great about the United States is what our founding forefathers set up for us, is that this political environment, while it's negative and contentious, it also works in our favor. Here's why. If you're a politician and you have to go back to your hometown, and the hometown has been shut down for now 6 months, it could be another 12 months, and you can't open your business, and it's been your livelihood, you're going to be calling your congressman, you're going to be calling your senator, your local legislator, and you're going to be demanding some answers as to either more relief while you tell us we can't open up, or we have to work together to fix it. So politically speaking, it doesn't matter if you're red or blue, wherever you are, it doesn't really matter. The founding fathers know that the constituents have to literally answer to or the politicians have to answer their constituents, and that's the brilliancy of what we see here playing out, because there's pressure building on Congress to get something done. So that's what we're going to look for. That's what the market's asking for. And there's a lot of dynamics at play. Federal Reserve Chairman even asked for that yesterday. There's only so much they can do. But at least I hopefully had a little educational lesson as to the inverse relationship of all the dynamics that are playing out and how it's all interconnected. And that's why we watch the Federal Reserve as well as Congress and fiscal and monetary policy. Thanks for watching, and tune in again next time.